The Fed's got a decision to make, and there's a lot of pressure on where they go in terms of rates and how they react. So I just want to talk a little bit about where we think the Fed's going to go from here. I have some projections, but it really is also about the people that are being confirmed, and also what the policy outcome is based on, a very tricky environment that we're in today. And the situation with Russia does not help that at all. It actually creates some inflation pressures, particularly as you're seeing the move up in commodity prices and what that can mean for Europe. And it's also coming at a time that Europe has been hit, in the northern part of Europe, with some pretty severe storms. So that is creating a lot of disruption. So we have a lot of noise out in the global economy, but I really want to focus on the Fed today. And after, we can talk about some of the other implications. But it's always good to look back, because we've gone through so much with the Fed since the financial crisis. And this is just a quick snapshot that says the GDP grew over that 10-year period 50%, debt grew over by 110%, but net interest on that debt only went up 53% because of the suppression of interest rates. You had corporate profits do well, and the market do exceptionally well with just shy of a 250% return over that 10-year period. That's led us to this kind of situation where you have that kind of growth in debt and that kind of growth in the global economy coming out of the strains that we have from COVID and supply chain challenges. And you have this really witch's brew going on for policymakers to figure out how to get out of here, and where do we go, and how do we get back to some level of normalization in the economy. And I've shown this chart plenty of times, but it really is important to keep in perspective. In 2009, in March of 2009, the Fed's balance sheet stood at just shy of $900 billion. And today it's at $9 trillion. So we've thrown a lot of money in the system, which has helped stimulate it, which has created a lot of that 250 basis point or 250% rally in the markets. But it's not just here. And the stimulus that I'm showing here is only from February of 2020 to May of last year. So that this money's still getting put to work in the system, which is why the economies have been able to weather some really significant issues, whether it's the supply chain, COVID, or now we have more conflict in geopolitics. So there are a lot of issues that are at play here, which makes it very tricky for policymakers to sort out what is in their control and what's not. So how do you make sense of the talking Feds? Because there is a lot of messaging going out. Some of it is purposeful by the Fed policymakers to kind of steer the market. Others is Fed governors trying to put their point of view out and get the market to follow up. And we think that was the case with Fed Chair Bullard, or Fed Governor Bullard out of the St. Louis Fed, who's been a proponent for moving up 50 and then 100 by June. A lot of people think that he's trying to pull the Fed along by forcing the market to those expectations and then have the Fed have to react to the markets. It's a trick used by Fed governors in the past. Whether it works now or not, he is picking up some other people who are getting more concerned about it. Today, you had Fed Governor Michelle Bowman, who is also saying we have to think about this now. And even the moderates, whether it's Governor George or Governor Meester, are also in the camp where they think that you have to consider it. But I think the moderates are in the view that you want to move on a more predictable path, that too much too soon is going to disrupt the economy at a time we can't tip it over. So you really want to listen right now to the Fed chair, because there are open seats and there are people moving, whether it's the governors from Dallas and Boston who are stepping down for trading issues, or just other changes that are going on. So we'll touch on some of those changes next. So this is a Fed that's in a lot of transition, and their mandate is under a lot of pressure because of the political environment that we're in. And the Fed's supposed to be agnostic to politics, and it's supposed to be independent, but that's not the reality. We have confirmations that are moving slowly because the Republicans don't like the new nominees. You have conflict-driven inflation and COVID-driven inflation, some of which is beyond the Fed's control, which has an impact on how they respond, but it's not necessarily what they can affect change on, such as the conflict with Russia and what it's doing to energy prices. So you really want to listen to the senior people, and that really starts with Powell. What he says will drive most of what happens, and he's going to be the voice you want to listen to. Chair Williams is another one you want to listen to out of the New York Fed. But there are new people coming into the stage, and these are the confirmations that are underway right now. Sarah Bloomraskin has a great background. She was a Deputy Treasury Secretary of the Treasury under the Obama administration. She's a former Fed governor, and she has a special background in climate and regulation. And she's nominated for a role of supervision, and that gets into the banking system and could impact how they lend and where they lend and what the restrictions are around that. But the one thing that you can be sure if she's put into this role, you will see a reversal of a lot of the deregulation that occurred under the Trump administration, and even a change in the regulatory environment towards more forces like climate and increased regulation, which is not necessarily good news for those that are being regulated. The next person you have is Lisa Cook, very talented governor. She's with Michigan State University right now. She has a big background in inequality and gender and racial inequality, but her focus is really on how hate-related violence impacts GDP and GDP growth, and it's a particular focus on the less privileged areas around the country. So this is really a big push to do better for the people that are being left behind. And then you have Phil Jefferson, who another strong academic, started out as a researcher at the Fed, has increased his, with the Fed for quite some time, is now a dean at Davidson University. His background is really on poverty and inequality. So you can see where this is a shift of focus for the Fed to really focus on climate and equality is a big change. And that has a lot of the Republicans resisting, and that's why you're having some delays or slowing approval in the approval process here. But it's clear to say that Lisa Cook would be the first female Black governor on the board. Phil Jefferson would be the fourth. So, Jack, I think it's safe to say that they're doing better than the NFL is in terms of diversity and inclusion at the Fed. And it's important because it's a better reflection of how our population actually exists today. But there are real issues in how you take the Fed policy going forward because of the extraneous events. And what they're really looking at is the projections that they see from their staff going forward. What I'm showing with the star in 2020 is where in December of 2020, the Fed saw real GDP for 2020. You were down at minus 2.4%. That was a big improvement from their September projection. But as you move forward, the 2021 is what the staff released and what the Fed governors were debating in their last meeting that the minutes were just released for. And you can see the strong GDP growth we had, the big drop in unemployment, the big rise in inflation. But then you look to this year, and at the end of this year, the staff believes that PC inflation will be back down at 2.6%. And in that environment, you would not be as aggressive in raising rates, particularly if you have new governors that are focused more on inclusion and equality, that is going to say, we want to let inflation run hotter to get the labor markets better improved and let people get their situations, financial situations better squared away. But the 2.6% number is the big number here. That is PC inflation, because that is what Chair Powell and other Fed governors will be saying. If we choke off the economy too soon, too fast, we could tip it into a recession when we don't believe at the end of this year inflation will be running as hot, because they believe a lot of the inflation comes because of the spike up in COVID that we had with Omicron, and you've seen that drop down pretty significantly in the US already, and the supply chain issues that are seem to be easing, particularly with the ports of LA and the ports of Long Beach. One big caveat on the ports situation is there is a labor contract negotiation for the port workers coming in July of this year, and that could create another disruption to the process. But in the long run, look at where they're thinking inflation's going to be and what GDP is going to be back to. And that if you're thinking 1.8% or 2% inflation or GDP growth against a 2% inflation rate, that's going to be a tough challenge to get too aggressive in raising rates. So we think the Fed, you can see what their projections are on the bottom, and the market is projecting a higher numbers. But what do we think is going to come out of the next Fed meeting? Well, the market has a lot of people thinking we're going to be at 50 basis points I'm not so sure. I think it depends on the next two inflation readings on the 25th and on the 10th, and also on the employment report. Because if you see more people coming back into the labor force, like we saw the participation rate rise, then you could see them to be backing off a little bit from choking off what they view the economy with aggressive rate moves. The 2.6% is the big number. Keep an eye on that and see it as that changes. If you read the minutes when they come out, there is a separate report that they write what the staff's views are, and they will create the chart that I showed you and where the ranges of views are from the staff members. Powell's the lead, and they'll do what he wants to do right now because of the uncertainty and because of the changing seats and the lack of confirmations. We think the steady pace is where they're going to go, because if they're right with the staff's right with inflation coming down, by June or July, they could see where that is. And rather than get too aggressive too early, they can adjust their pace later on. They're also doing other things to tighten the economy slowly. So I think you can expect to see some yield rise, but not too much more from here. And we think it's going to be slower than what the market's projecting. We think the Fed moves will be less than the 6% or 6 or 7 times that they're talking about. We think there are real challenges in the global economy, which could impact the US economy. And certainly when you have conflicts like you're having with Russia and Ukraine, that there could be some challenges. So we think the Fed's path to normalization is going to be one where they're going to try and toe the line without tipping the economy into recession. And if they can thread that needle, that's going to be the real challenge. So I'll just say our view on this is don't factor in the highest level of rate increases that you're hearing. It's too late to be too aggressive at this point in the cycle. Clearly, in both cases, in the great financial crisis and with COVID, we overstimulated, but it's easier to say that after the fact than it was when you're in the throes. And if you go back to the feeling that you had in March of 09 or March of 2020, when it looked like in both cases, we were on the brink of a massive, massive depression, if not a deep, deep recession. What the Fed stepped up and did was the right thing at the right time, but probably a little bit too much, too long. And I think that's easy to say in hindsight. We think this is creating big volatility. It's repricing the equity markets. So that's created some nice opportunities, but I wouldn't be chasing short-term opportunities unless you're an exceptional trader. We would focus on the secular trends. Earnings is going to be strong. CapEx will continue to be strong, but the beneficiaries will not be shared. And longer term, what the Fed and other central banks are really focused on is the debt, demographic, and deficit issues, which are going to limit what they can do. And we think will reinduce deflationary pressures on the system as we move out of this year into next year. So I'll stop there, Mark, and open it up for questions or comments.
Oh, questions or comments?
Stephen, thank you for this presentation. It was really good. I have a question on, as we think about some of the biggest companies now and that have grown over the last 15 years, none of these tech companies in particular have gone through cycles. And so there is this risk that we could be seeing another interest rate cycle. Do you have any comments on more generally how that might be an impact? You know, we are seeing these transitory effects, but there are also some pressures out there that suggest it could last longer. Is there a vulnerability in tech in particular when you have not seen these kinds of cycles in those industries, particularly for the newest companies?
Well, I think you have to separate out the megas from the rest of the world because their balance sheets are so strong and their growth rates are so strong still that they can withstand higher rates and tightening cycle, but they will be impacted. I think the bigger issue for the mega tech stocks is going to be, can they sustain the growth rates in their new businesses like the cloud? And can they keep innovating and can they keep buying against a backdrop where there are significant shifts? Ken mentioned earlier what's going on in the advertising space, and that is taking a real hit on Google and Facebook, for example. What's going on from a regulatory environment towards Apple? They're in the sights now too. So I think the bigger issue for these guys is their growth rates in their regulatory environment, because they certainly have the strong balance sheets and right now the high growth to withstand it. I think it's some of the newer tech companies that don't have necessarily the financial wherewithal to deal with shocks to their balance sheet that are going to make it a tougher road for them. And then again, like all tech, it depends on can you commercialize to the level you need to fast enough in a difficult environment. So I think that you'll see multiples come down as rates move up. You've already seen it happen. And that's why you've seen inside the market, when a company announces, you've seen declines of 27, 30% for some of these newer tech companies because they don't have the history of dealing with those periods. So I think it's absolutely a great point, and it's certainly a time to be really cautious. But some of these pullbacks are so severe that you don't have to rush into them, but you can start towing into some of these. I would give it a little more time right now with the volatility and uncertainty around what's going on in Europe. But I think it does set up, not right now, but over the next couple of weeks and months, to start to tow into some of these better quality names that you can make some money on.
Stephen, good morning. It's John Pagley. Thank you for briefing. Not to force anyone to have a crystal ball, but if we take at face value the headlines that China is, let's say, very constructive on Russia's position, do you believe that opens the door wider for China to exert extra pressure in whatever form on Taiwan and hence the supply chain for, let's say, semiconductors?
There's a lot in that question.
I know, not the witness.
Let me just say that from prior to the Great Wall, to the Berlin Wall coming down, and to the, prior to 1989, and from World War II to that period, I think democracy was more important to international relations than capitalism was. And I think after the wall came down, capitalism became more important than democracy. And I think that opens up a door for autocratic leaders to do what they want to do. We have a difficult situation in a lot of parts of the world where they're not in really strong economic or political situations because of COVID, because of supply chain issues, and because of the general disruption still from these two great crises we've had. So it's hard to get the world to line up against it when you think that, economically, what's at stake. Russia's roughly the 12th largest economy in the world with about a $1.6 trillion economy. Ukraine's economy is roughly, $170 billion. So from an economic perspective, what's going on in Europe is not that big, but what you're talking about, what China's doing, that could be big, and it could create a lot of disruption. So this is a good environment if you're an autocratic leader to take advantage of the situation. How far they go and what's the will of the world to step up against that and fight for democracy as opposed to capitalism, I think is going to be an interesting challenge. As it relates to supply chains around technology and semiconductor chips, whatever happens is going to happen. The wheels are in process to fill the supplies and create new supplies for it. But we are definitely moving in a funny way, the world is evolving. Canada just approved to sell one of their best lithium assets to China. Not exactly the kind of world that you'd be worried about that. Whether that's really insightful or terrible planning, I'll leave to others. But you have a very funny setup right now, geopolitically and economically, to thwart those guys right now, because people are more worried about their own populations than the global economy as a whole right now. And I think that's the challenge. If you're a leader, your responsibility is first and foremost to your country, and in most leaders' minds, it's to get reelected. So I think it creates a lot of uncertainty, and it's coming at a time that key leadership roles are either have changed, are changing, or dealing with weak hands. So you have elections coming up in France. You have a new leader in Germany who actually has stepped up much greater than I thought he would. And I think I criticized him a couple calls ago, so he deserves an apology. Schultz has stepped up and done more than I think a lot of other leaders have. But we're in a very funny scenario, John, and I don't think anyone really knows how that's going to play out. Game theory suggests that these guys are going to take what they can while the world's dealing with other issues.
Yep, as I figured. Well, thank you for that. Rather hear
Barry, did you have a question?
No, Mark, I'm good. Thank you.
Okay, just sorry, cut you off, John. I just want to make sure everybody got a chance to.
Steve-
Of
Stephen, I've got a question for you.
course you do.
Given the volatility, the likelihood of interest rates going up, how is there any concern about systemic risk being built up in the banking sector, particularly in areas of buy now, pay later? I mean, that's going to affect those new technologies, those businesses. Is there any view on that? Have you read anything about that?
I'm not great on the buy now, pay laters. There are others much more capable of speaking to that. I will talk about debt in general, though.
Okay.
We had a financial crisis that has taken debt to resolve the financial crisis. So we increased our debt by something like $60 trillion over the 10-year period globally. So as rates are moving up off these low levels, as Buffett says, you're going to see who's swimming naked, right? When the tide goes out. I think there are going to be a lot of people get exposed for this and get caught on the wrong side of what they were counting on, of either higher growth or rates staying lower for longer to allow them to have the time to deal with their debt. I do think that is one of the challenges that China's facing right now, is they have a big debt issue that they're trying to deal with, and they have a growth issue that they're trying to slow growth but stabilize it and keep their populations happy. So I think that you're going to see those issues be real issues and continue to be real issues, and it's just a question of how fast can we grow the global economy against the rate of the growth of the debt of servicing those, the rate of the cost of servicing that debt grows. And that's the challenge that every country is going to have right now. And it depends on how high rates move up and how bad the problems get. I suspect in the US, that's not going to be as big a problem. I think in other areas, it is going to be a bigger problem, and that's going to have to be dealt with. And if we can't get the growth rates on a sustainable level above that 2%, and we keep growing debt at the rates we are, then we're going to have a debt jubilee at some point. Or keep rates exceptionally low for longer. So you could have an artificial resetting of rates against a backdrop of higher inflation, which creates other problems, as you know.
Another question, comments?
I would just say, Mark, one other thing about the new nominees for the Fed, and one of the outcomes, if they're all confirmed, based on their focus on climate inequality, that could change the regulations. The climate issue could change the regulations for lending to the fossil fuel industry, which could make those assets even more valuable for the companies that are producing massive cash flows right now in the old oil and gas areas. And what's going on with Europe is actually creating more value for those companies, but it's going to create more pressures for the regulators to reduce the lending to them, so we can shifter. If you're trying to push a climate agenda, you're not going to promote fossil fuels as much as you are renewables. So that's an issue. The other is that if you're focused on inequality, you're going to let inflation run a little higher to get employment in a better rate, in a better position, and even let it run hotter for longer than you might normally. So we have these big conflicts in the desires of where people want things to be and where they should be, to how do we get there and how fast can we make these changes. And I think that's going to be the big debate in the Fed going forward, is how fast do you raise rates if you're trying to help the people that are being left behind. And those people are getting hurt by inflation. So it's a dilemma for them too, because inflation hurts the lowest income people more than the highest income people. So what's more important, getting them in jobs or keeping the costs down? I think it's going to be a real challenge for them to thread the needle. So I think that's what the Fed's looking towards. And in that environment, if we keep rates low, you can see debts continue to rise. And at some point, the bill comes in.
Stephen,
So go ahead.
could you speak to some of that labor market a little bit? You mentioned a big negotiation coming up, I believe, for port workers out of the West Coast, out of those ports. I know of the headlines and a lot of the news about the strikes that have happened in 2021 and the result of those strikes. Most of them have been negotiated. They have some significant escalators in there, but those are the headlines, right? Those are the ones that you know about. I would imagine that more of the negotiations are less headline worthy and are actually happening. They may not include such significant increases to payroll every year. Is there a risk here? Because that's a significant labor source in terms of supply chain disorder and pressure on inflation.
Absolutely a risk. And you're right, there are a lot that aren't discussed. And even inside some of the COLA adjustments that have been put in, they're tied to the company continuing to grow so that if the company doesn't achieve targets, then those COLA increases don't automatically kick in. That's a lesson that some companies learned from the 70s, and that's going to be a fight in the labor negotiations. But yeah, we are at a vulnerable spot in the global economy right now and in the US economy as well. But I think the US is slightly in a somewhat better position than others are, but you just can't keep giving raises without the other side of it going up. You got to get the revenues up to justify and earnings to justify the wages. And if you don't, then you can't win that way. So I think what's going to happen is in a lot of these, you're going to see the wage rates go up, but the wage bill not, because they're going to substitute capital for labor with robotics wherever they can. And they're starting to do that in the ports already. So it's just a question of how fast can you do that and how effective are you at doing that? So not an easy solution, and a lot of uncertainty there as well.
Oops, I am sharing the wrong thing. But any other questions as I get recalibrated?
I have one for the folks who have a big background in Russia and Ukraine. What do you think? How far is it going to go?
He's going to take, he'll take the provinces that he declared as sovereign. And I don't think he'll go beyond that, is my view. He may do a little damage in Kiev, but otherwise I don't see a full occupation. Although he has set the pretext, or he has set the stage for a full occupation of Ukraine, but not in the very near future. That's years away. But certainly it's the same playbook that he did with Georgia.
Anna, what's the percentage of GDP of Ukraine that comes with that sliver?
I thought it's a good idea to invite Mark.
What's that, Simon?
I think Simon was on another call.
I was just curious, what percentage of the GDP you think comes from that part of the country?
No, don't forget that. Okay, don't forget about two factors here. Number one, Russia already occupied those separate regions in Luhansk and Donetsk provinces since 2014. So what Putin does now, or what he is doing now, is saving face while regrouping. Okay, so he just kind of legitimizes his own army on those territories, which everybody knew was there in the first place. In terms of the GDP, I don't have it off the top of my head. The critical question there is not that. The GDP in the areas which are already occupied is near zero. You know why? Because Russia plundered those, and when I say plundered, they literally cut down the factories and machine works, and some of them got exported to Russia, so to speak, and set up there. So the economic potential of that region is near zero right now. But the thing is, if they decide to move further, because the self-proclaimed republics from the start, I think they claimed that their legitimate territories, quote unquote, include the entire territory of Luhansk and Donetsk provinces. That's a bigger threat, and this is, I think, this is what Putin is considering as the next step, maybe not immediately, because for now he has enough on his hands to declare victory at home. So this was like literally a face-saving exercise for him. But if they decide to move further, that's a serious threat, because not only that includes some major assets in the steelmaking business, including my former employer, who's already lost a few steelmaking plants and a few coal mines in that region. But it's also the access to the Azov Sea and to the Black Sea, and that could have more devastating effects to the economy overall. But again, given where the Ukrainian army is right now compared to 2014, this is going to be a very bloody and costly exercise for Putin. So I fully expect him to continue with some kind of provocations and probing along the division lines that exist right now, to provoke some kind of response from Ukraine, and then use that as casus belli to expand the occupied territories.
Yeah.
But I think for now, it's gonna stay where it is.
It's fascinating that of respect for China, he waited till the day after the Olympic closing ceremonies so he could not alienate another country while he was doing it. But
well, China is a bigger threat to Russia than and again, NATO. Putin pretends that NATO is a threat to Russia. It's never been a threat, and this is just false pretense. China is a much bigger threat, because Russia's territories that are attracted to China, which is Siberia, are utterly empty. Russia doesn't have resources to keep them. I mean, Russia doesn't have resources to protect them. So I fully expect China to make the same play Russia did with Crimea. So China will saturate the east of Russia with its own inhabitants first, and it's already an ongoing process, and then declare it the territory. Like they would need to protect their own citizens, and they will move in. How long this should take, I don't know, probably another 20 years or 30 years, but I view that as a possibility.
Adam, were you living in Moscow when the April Fool's Moscow Times came up that Russia bought the Far East, or China bought the Far East from Russia?
I think I was either in Tajikistan or I was out in Samara on the Volga River region. But yeah, I do remember that.
But a lot of us bought it. Like, yeah, that makes sense in some ways, but not to Russia.
Well, to the point of China being a bigger threat, China has already, over the past few years, floated the idea that Vladivostok and Eastern Russia is Chinese territory and should be taken back. That has been floated.
how ironic would it be?
Well, that was not an
President Xi did
official level, but with some academicians, right?
Correct. That's right. But it is something that they throw out there in the press that they have done a few times. Yeah.
Think of the irony if that came back to be the play that they used on Russia.
And I agree that is something that would take probably 20 years. Yeah. But I do see that as a real possibility.
And just the other thing to keep in mind on how far they go, if they don't have much time if they want to take the whole place soon because of the weather.
Well,
Right.
Stephen, you need to understand, they have absolutely no chance of taking over Ukraine. It's like there is absolutely no chance militarily. They can bomb the hell out of cities. They don't have sufficient manpower to make the full-scale inland invasion to overtake Ukraine. They can have another land grab, but again, given where Ukrainian army is after 8 years, combat ready, strengthened with this additional shipments of javelins and stingers and other military armaments from the West, there is no chance. I think he understands that. That's why we haven't seen the full-scale invasion right? Because if he could, he would have already. Why would you transmit your intentions the world over, right?
Yep.
You just do.
No, that's,
So
and the Russian people do not, the Russian population do not want this. They don't have a stomach for a war with Ukraine.
Adam, I would disagree with you. I would disagree. The Russian people are irrelevant. If Putin, as the new Tsar, wants them to go to war and expand 100,000 of them, 200,000 of them, it's Russia. Nothing will happen. I mean, I'm convinced about that. So that is the danger.
Well, we'll agree to disagree. I agree with you, the point that it is Putin's decision, yeah, and that's not going to be challenged. The Russian people, he does run a big risk of civil unrest when those body bags start coming home, especially from Ukraine. That's not going to go over well. And there is fracture within the inner circle, and you are hearing.
Well, maybe to that point, Adam, we were talking before you came on, because there's some people that we know that have been arrested under
Yes,
whatever pretexts, and
Right.
and it turned out that they were, it's like, does Putin really pull all the strings? There's a group that said that it was he told them not to do that, and yet they did. Siloviki.
that is true. That is true as well, Mark. And the people that are whispering in his ears are the likes of Nikolai Patrushev, who's really, if you ever read his stuff, that's really way out there. And Botnikov, who's the head of this right now, he's likely to be replaced this year. He's not well. And the chances are that the leading candidate to take his position is another pretty far out there, Karolov. He's deputy of FSB at the moment. And it's not looking good. And this is going to be the new normal, I think. I'm sorry to say that. A Russia that is aggressive. That's what we're going to have to live with.
Why new? Adam, Russia has been aggressive through ages, through centuries.
Let me
Well,
just we hit this